Welcome to Talk Tickers. We cut through the noise of earnings calls to bring you the critical insights for experienced investors.
And today we're diving deep into the Netflix Q1 2025 earnings call.
So what are the key takeaways right off the bat? What's the general vibe?
Well, overall, the call painted a picture of a business performing consistently well, pretty stable.
Okay.
Netflix reported exceeding $40 billion in revenue, now serving over 300 million paid households.
300 million, wow.
Yeah, and reaching an audience, they estimate, of more than 700 million individuals.
Huge reach. And retention. How's that looking?
Importantly, subscriber retention remains robust, quite strong and stable. They didn't see any significant changes in, the mix of plans people are choosing or take rates.
And the financial outlook seems steady, too.
It does. They reaffirmed their full-year operating margin forecast at 29%.
Okay.
Plus, a significant growth area to watch is advertising. They anticipate revenue there roughly doubling in 2025.
Doubling. That's ambitious. What about regional performance? Like UCAN?
UCAN revenue grew by 9% year over year in Q1. The expectation, though, is that this growth will pick up speed again in Q2.
Right, reaccelerate. And cash flow.
From a cash perspective, their free cash flow guidance for the full year remains strong at $8 billion.
Solid number.
And the underlying trend points towards continued growth in free cash flow generation going forward.
Okay, so that's the high-level snapshot. Let's unpack some of the more nuanced discussions from the call.
Absolutely. Where should we start?
How about the long-term vision? There was that Wall Street Journal report mentioning, potential internal goals, doubling revenue, tripling operating income by 2030. How did management talk about that?
Yeah, that came up. They record those are long-term aspirations, not formal forecasts, not guidance investors should, bake into models right now.
So aspirational, not predictive.
Exactly. But what's really interesting is the context they give for those ambitions. They highlighted the sheer scale of the opportunities they still see.
Like what specifically?
Consider this. They estimate they currently capture less than 10% of total TV viewing hours globally.
Less than 10%. Still so much room.
Right. And then you think about the hundreds of millions of households worldwide that haven't subscribed yet. Plus, Netflix only accounts for about 6% of overall consumer entertainment spending and ad revenue in their markets.
So when you frame it like that, those long-term aspirations, while not guidance, they seem grounded in a massive addressable market.
Precisely. The underlying message is one of substantial, untapped potential.
Okay. Now, shifting focus a bit to the present economic climate, obviously a factor on everyone's minds. Did Netflix indicate they're seeing any significant impacts from broader economic uncertainty?
That's a key point. They reported stable and strong retention rates, and subscriber choices regarding plans haven't really shifted meaningfully. Engagement levels also remain healthy.
So resilient so far.
Yeah, and it's worth remembering that historically, entertainment, and Netflix specifically, have shown resilience during tougher economic times. People still want entertainment.
True, and the ad plan probably helps there too.
Exactly. The availability of that lower-cost, ad-supported tier in major markets likely adds another layer of resilience. Their focus, they said, remains squarely on continually improving the value proposition for members.
Makes sense. Let's delve into their approach to pricing then. It sounds like they're not operating on a fixed timetable for price adjustments.
No, not a predetermined schedule. Future changes will be driven by the value they believe they offer subscribers, their perceived value, and also their own needs for reinvestment in content and tech.
So value-driven, not calendar-driven.
Right. It's a value-centric strategy. And by offering a wider array of price points, including that ad-supported option, they aim to provide the right plan at the right price for a broader range of consumers. That flexibility is likely key to maintaining growth and retention.
Speaking of retention, it continues to be a real strength, you said. Q1 built on the strong trends from Q4.
Strong acquisition and retention continued.
Was there any difference for subscribers who joined specifically for big live events, like that Paul Tyson fight or the NFL game?
That was an interesting question. What's insightful is the consistency they observed. Netflix reported that the retention characteristics of members who signed up for those big live events were pretty similar to those who joined for their regular big shows and films.
Huh. So live events aren't just a flash in the pan for signups.
It seems not. It suggests they're attracting members who engage with the platform in a typical way, not just dropping off immediately after the event.
Good sign. Okay, let's turn to profitability. They maintained the full-year operating margin forecast, 29%. But they mentioned expecting some quarter-to-quarter variation. What's driving that?
The main driver is the timing of their content slate releases. That's usually the case.
Right.
They anticipate content expenses will ramp up in the back half of the year, Q3 and Q4. That's due to big returning series coming back and a heavier film slate planned for Q4.
Okay, so more content costs hitting later.
Exactly. And sales and marketing expenses are also projected to increase in the second half, partly to support those content launches, but also to continue building out their ad sales operations.
Got it. So the Q1 operating income beat expectations, but that was mostly timing of spend.
Largely, yes. That spend is still expected, just spread throughout the year.
Understood. Now, the advertising business you mentioned, they expect it to double. That seems like a real engine for future growth. They sound optimistic.
Considerable optimism, yes. And interestingly, they haven't seen any signs of weakness in the upfront advertising market.
For those maybe less familiar, the upfronts are where advertisers commit spending in advance, right?
That's right. And what's potentially helpful for Netflix here is that compared to the overall ad market, their current ad revenue is still relatively small.
So maybe some insulation from broader market swings?
Potentially, yes. A crucial piece of this is the ongoing rollout of their own proprietary ad technology platform. It's live in Canada and the US now, with the other 10 ad markets set to follow.
And having their own tech stack, what does that enable? What are the benefits?
Several key advantages. It makes transactions, buying and selling ads, much easier, and it lets them roll out new features faster.
Like what kind of features?
Things like offering programmatic advertising, much more precise targeting using Netflix's unique viewer data.
What kind of data?
Think life stage, interests reflected in viewing habits, maybe even viewing mood. Also allowing advertisers to bring their own audience data, use Netflix modeled audiences, tap into third-party data segments.
Okay, lots of targeting options.
And importantly, improved measurement and reporting on campaigns. The long-term vision, really, is to make ad recommendations just as sophisticated and personalized as their content recommendations.
That's a high bar. Okay, live content is another area of investment, and it's not just sports, right?
Correct. Their strategy seems to revolve around creating large-scale, culturally significant events, things that get people talking, resonate broadly, and also make economic sense for them.
And they're seeing positive results.
They said these live events have shown outsized positives in conversation, acquisition, and potentially retention, too.
Any upcoming examples mentioned?
Yeah, the Taylor-Serrano fight rematch and another NFL game scheduled for Christmas Day 2025. And they explicitly stated their intention to expand these live capabilities globally.
Interesting. What about video podcasts? That came up too. Growing format.
It did. They acknowledged the rising popularity and pointed out they already produce audio podcasts related to their own content.
So could we see video podcasts on Netflix?
It seems like a logical potential step. Given their video infrastructure and podcast experience, if the format keeps growing, it wouldn't be surprising to see some find their way onto the platform.
Makes sense. How about animation, building franchises there?
That's a stated goal. It's obviously a creative process, so there are hits and misses. They mentioned successes like Leo, Sea Beast, Guillermo del Toro's Pinocchio.
Right, some big ones.
But they acknowledged it's not always a home run. The key driver is the strong global demand for animated films.
And their strategy, making versus buying.
Both. Creating their own original animated content, but also licensing content through output deals. They highlighted a promising slate of exclusive animated originals planned through 2027.
Okay. Another area they touched on was that huge chunk of TV time, like 80%, that neither Netflix nor YouTube currently holds. They see an opportunity with shorter form, creator-led content.
Yeah, that was interesting framing. Their thinking is that they can offer a more compelling platform for certain premium creators and formats, especially leveraging their established monetization model.
Any examples they give?
They pointed to things like Miss Rachel's, Kill Tony, and collaborations with groups like Sidemen and Pop the Balloon as successful examples already on the platform.
Got it. Let's talk AI. Artificial intelligence and content creation. How is Netflix using it?
They sound quite enthusiastic about using AI to improve things for both creators and members.
In practical terms.
Current uses include generating set references, pre-visualization, helping with VFX, sequence prep, shot planning, that sort of thing.
So tools for production.
Exactly. They also highlighted how AI is enabling smaller budget projects to achieve really high-quality visual effects. They mentioned the film Pedro Paramo, where AI significantly cut the cost of de-aging effects. The focus is very much on using AI to make content better.
Makes sense. Well, it's such a massive library. Discovery is always key, finding stuff to watch. Any updates there?
Yes, this is critical. They're testing a new, simpler TV homepage. Apparently, it's the first major structural change to the homepage in over a decade.
Wow. When might we see that?
Planned for rollout later this year, assuming tests go well. They're also developing new capabilities like interactive search using generative AI.
Interesting.
And of course, continued improvements to the recommendation engine remain a constant focus,
Yeah.
all about connecting viewers with content.
Okay. What about those extra member accounts? The page sharing feature, how's that performing?
It seems to provide valuable flexibility for members who want to share. And they said retention and engagement for those using it are good.
But it's not a huge growth driver.
No, they positioned it as not being a major driver of the overall business. They expect it to remain a relatively small part of their offering.
All right. And gaming. Still feels like early days, but they're investing.
They view gaming as a multi-year, iterative journey, kind of like launching new content types or expanding into new countries historically. It takes time.
What's working so far in gaming?
Successful categories include, the deceleration in Q1 was mainly due to pricing timing when price changes took effect, and also a tough sequential comparison because Q4 had benefited from those NFL games and related ad revenue.
So Q2 gets the full benefit of price changes.
Exactly. The full year-over-year benefit of pricing kicks in, plus continued growth in the smaller but growing advertising business in the UK and Canada. That's expected to drive the reacceleration.
Makes sense. And finally, capital allocation. Any changes to the strategy?
No, the policy remains consistent. Priority 1, reinvest in profitable growth. 2, maintain ample liquidity, enough cash on hand. 3, return excess cash to shareholders via share repurchases after hitting a minimum cash balance.
So buybacks are the main return method.
In the absence of significant M&A, yes. They expect growing free cash flow will primarily be redeployed into share repurchases.
Okay. And before we wrap the core discussion, they took a moment to acknowledge someone leaving the board.
Yes, Tim Haley. He's stepping down after over 27 years on the Netflix board. Quite a tenure. They recognized his valuable counsel and leadership through massive growth and change.
27 years. Incredible. All right, so you've got the detailed breakdown from the Netflix Q1 2025 earnings call. Now, for our signature, this is not financial advice segment where we get a little creative.
Let's hear it.
Okay. Considering Netflix's big push into advertising, the doubling projection, the proprietary ad tech rollout, here's a truly speculative idea for you.
Right.
Ever heard of companies specializing in analyzing viewer engagement and advertising effectiveness within streaming platforms? I mean, going beyond basic clicks and views to understand emotional responses, predict content resonance using AI.
Right, deep analytics.
Exactly. Imagine a company developing AI tools that analyze viewer behavior on Netflix itself, providing super granular insights to advertisers.
Yeah.
Like, how did this ad feel next to this specific scene? Did it enhance or detract?
So, measuring the qualitative impact.
Precisely. This isn't a direct play on Netflix stock, obviously, but if their ad business genuinely explodes like they hope, the demand for sophisticated next-level analytics within their ecosystem could create a really lucrative niche.
Interesting. The picks and shovels play for the streaming ad gold rush.
You got it. It's definitely a long shot. The tech is still evolving. Who knows if Netflix would even allow that level of third-party analysis. But if Netflix's ad ambitions fully materialize, the demand for understanding what works inside the walled garden could make such a specialized analytics firm surprisingly valuable.
A thought-provoking angle.
But remember, folks, this is purely hypothetical, just mental gymnastics, not investment advice. Always do your own thorough research before making any financial decisions.
Absolutely.
So what are your thoughts on Netflix's multifaceted growth strategy? Where do you see the biggest potential wins or maybe unexpected challenges ahead? We'd love to hear your perspective. Join the conversation.